Hello and welcome to our latest urgent market update video brought to you by the live trade room. Now today is Tuesday the 4th of April 2023, and in this short video we're looking at this. Currently we're seeing this kind of risk on, indices higher, dollar lower type trading environment, and we're seeing some very important technical levels be breached, and I'll clarify those shortly while we look at the charts. But the question is, with a bit of a quiet period over the last couple of weeks, perhaps there's been a lack of sort of major market influences. The question is, how long will this current market cycle last for? So let's get straight into it then. We'll start, of course, with our risk warning. Just broadly be mindful of the risks involved in trading financial markets, and do take note of our risk warning currently up on the screen. Okay, good. So let's get straight into it then. We do have a little bit of a narrative that we kind of want to try to explain in a few minutes' time. But what I want to do at this stage is to just share the technical backdrop to these markets. And if we look at the S&P 500, this is currently S&P 500 chart, and we've been in a phase of accelerated buying for the last 4 or 5 trading days. There is periods of kind of quite choppy price action within that, but nonetheless, we're making higher highs, higher lows. We're clearly in this risk on market condition. But if you look at and zoom out a little bit on larger timeframes, it gives you much better context in terms of where we're at in this overall sort of market cycle. So in 2022, we saw a massive rollover to the downside. We're all very aware of that. And since October of last year, where we kind of bounced off the 3,500, basically, we've pretty much rallied and drifted sideways for the majority of that period of time. So 2, 4, 5 months have been, broadly speaking, drifting sideways. Now, over the last 3 or 4 weeks, we had a mini banking crisis. We had issues with Silicon Valley Bank, Credit Suisse, which has been bought out by UBS. So we had a bit of a banking problem, and that's just really down to interest rates being pushed higher relatively swiftly. It's causing major problems for certain banks that are perhaps overexposed, and we're seeing a few banks struggle because of their management and profile with risk as well, and some of the investments they've been involved in. Perhaps in hindsight, they shouldn't have got into certain investments. So we've got a little bit of a banking crisis. It's interesting to see over the course of the majority of that period, we've actually seen the equity markets push higher. Now that's just broadly just quite surprising, although really nothing should overly surprise us with these markets at this stage. But I just want to draw your attention to the fact that we're pretty close to creating a structural failure trade to the upside. And that's when we break out of this little downward trend that we've been in since January of last year. So that's firstly, that's really quite important. It's the same principle really across these markets. If we look at the monthly time frame, we'd be very close with the Dow Jones, for example, creating a structural failure trade to the upside around the 35,000 level, and the structural failure trade in markets like the Nasdaq, as you can see, has already kicked in. So we could have a bit of a catch-up trade as far as the S&P and the Dow Jones are concerned, because we've already seen, as you can see currently up on screen, the rollover to the downside for the tech stocks and the Nasdaq, and then we went through this 5-6 month volatile stage, and then, like we've said, during the last 3-4 weeks, we've seen a really sizable move across the tech stocks. And we're looking like we're on the verge of seeing further momentum to the upside. So we're currently in these markets to the upside. And for now, we are able to continue with those types of trades. Other equities are in, let's say, a smaller bullish phase as of recently in terms of the last few weeks. This is the FTSE pulling back off the highs. and now we're seeing 2 weeks of quite bullish price action, and we are just anticipating further upside in the over the near term. The DAX is very close to these recent highs, and again, we're all currently trading. Most of these markets are trading around last month's highs, and we would just expect continuation at this time. So when we look at these markets from a technical perspective, and I do just want to have a quick look at markets like the dollar, we're at very important levels as well in markets like your euro-dollar trade. And if we look out at bigger time frames, we're on the verge of kind of potentially seeing the US dollar actually start reverse its previous strengthening process, and this is the first major structural failure trade to the upside, at which point we would probably look to shift our sort of bullish view on the dollar and begin to turn negative. And we're at these pivot points across an awful lot of these markets. We've had 4 months of sideways moving volatile price action, and now, as you can see, we're breaking out of this really long-term sideways moving price action, and we would just only anticipate further upside there. So we'll look at markets like the indices and the dollar, just to give you a little bit of context. And some of these markets are at very important levels as we speak. So the question is, what's likely to change the fortunes of these markets, the indices to the upside and the dollar to the downside? Well, if we bring over Forex Factory, we just explained the distinct kind of lack of like major market movers. We've had a fairly positive reopening across the Chinese market, so that's adding a little bit of sort of global uplift. We've had a mini banking crisis, which seems to be resolved. It could have probably got out of hand pretty quickly, but the authorities jumped to the aid in the form of sort of multiple sort of structured bailouts. So we're back into that sort of moral hazard type environment. Who should we be bailing out in situations like this? But it did prevent, kind of a global banking issue. The question now becomes, how tight will real lending be into the real economy, and is there any more banks that could be in serious trouble at this point? So over the last couple of weeks, we've had a little bit of a lot of sort of positive rhetoric around inflation. We're seeing inflation in some quarters, improving in terms of headline inflation. When we look at we've got headline inflation and core inflation as well. Core inflation is remaining really quite sticky. So we have this situation with, OPEC yesterday. We might as well sort of bring that into the fold. So indices higher as well. And we've seen a very significant gap to the upside with further upside potential. Now we are awaiting response from the US and Europe regarding the political decision from Riyadh and the Saudis, making these supply cuts. So kind of it's a blatant affront really to Western economies. So this is the concern really on the inflation side of things. If core inflation is already really quite sticky, we've still got quite high services inflation. We've got a situation now where the headline rate could be hit quite dramatically if we start to see further upside price action. And again, this is a pretty linear kind of pullback off the lows, but if we get above that $81, $82 level, you'd probably expect further upside from there in US oil as well. And not to mention last Friday's core PCE price index number coming in lower than expected. So it does look like we've got some improvement on the Fed's preferred indicator. So we are rolling into important job numbers. We'll be hearing from the RBNZ. We've already seen the RBA keep rates at 3.6. Basically let's wait and see. However, if we need to increase, we can do. keeping all options open. That would be important. So this week we're going to be hearing from the RBNZ and get a lot of US employment data out. So the Fed are trying to engineer a little bit of softening across the jobs market and a bit of a recession, but obviously if that can be quite shallow, that would be preferred. The problem is, as we saw from the banking situation over the last 3-4 weeks, is that things can go wrong very, very quickly, and then it's up to the reaction from the authorities in terms of how they respond and the speed of that reaction as well, which will be in focus. So with this employment numbers coming out, with inflation up at 6% in the US, and if the jobs market still remains really quite resilient and strong, which it currently is, with unemployment rate remaining stubbornly low, then it does probably give a green light to the Fed for further upside in terms of interest rate hikes. And that means we're potentially under threat for further fallout elsewhere. And this is the dangerous game that these central banks are currently playing. Just wanted to leave you really with two major market narratives. We're currently in this risk-on phase. There is an expectation that with that the Fed are very likely to pause and potentially pivot their rate hikes, with a lot of people calling for much lower inflation between now and the end of the year. So we're seeing this kind of positive market response, indices higher, US dollar lower, which is the title of this particular video. We're also seeing sort of US bond yields sort of remain. They've fallen off a little bit of a cliff over the last month or so, and they're remaining at those relative lows, although we still have inverted markets across the 2-10-year. And commodities potentially higher, so that gold and oil market potentially to the upside as well. So what we're just mindful of is this narrative shifting. So we'll have to look at the job numbers coming up and what other catalysts are likely to bring about real concern. Not forgetting that we're going to have first quarter earnings due out in the next couple of weeks. So that this narrative could shift very, very quickly to being a broadly risk-on type market condition now, could turn risk off very quickly. However, we do have technical levels supporting this risk-on trade. So it is the trade of choice for now. It is the trades that we're currently in. We're currently in the indices and the dollar weakness trade. We want to see if we can build out more of these trading opportunities and see if we can kind of maximize return on those trades. Okay then guys, listen, thanks very much for joining us as always. If you do have any questions about anything covered in this video, don't hesitate to email us at support@thelivetaderoom.com. One of us will get back to you as soon as we possibly can. So from everyone here at the Live Trade Room, guys, thanks so much for joining us again. Do stay tuned for our next video. And just to let you know, we do broadcast our trade plan sessions live every morning from 7:30 a.m. And we trade these markets fully live and interactive from 8 a.m. for the European session, and again for from 12:45 p.m. all UK time. And just for more information, do feel free to go to thelivetraderoom.com and you can connect with us there through our website if you need. Great stuff. On that note, thanks so much for joining us. Keep an eye out for the next video and we'll see you soon. Bye for now.